Leading macro indicators and yield curve inversion signal a recession is coming. Equity vol collapses ahead of earnings and Easter. And commodities give a buy the dip opportunity as Biden gets desperate. All this and more in this week's Macro Insight. So welcome back to Macro Insight, everyone. Welcome to any new subscribers, any free trialers. Good to have you here, and let's crack on. So last week, what did we have? Now, it wasn't quite as volatile as it has been recently, which makes a change. We did see, 2-year rates in the US continue charging on. These are like the main sort of changes that we see in standard deviation terms last week. So kind of leading the charge again, still US 2-year rates, as the market just prices in that the Fed is just going to go a bit nuts this time around, or needs to. They're so far behind the curve. So 2-year yields hitting around just shy of 2.5%, which is like a cycle high at the moment. Chinese and Indian stocks also rallying pretty strongly. Some loosening on the regulation side potentially coming for China tech. There was that issue with the audits being available to the SEC and things like that. So that's softening a little bit, and you're seeing a decent rally there out of China tech. Commodities taking a hit last week as Chinese lockdowns in the big cities due to COVID and aggressive tightening expectations, as we're seeing in the front end of the curve, brought inflation break-evens down quite a bit lower. So you're seeing inflation break-evens down around 2 sigma. We saw soy and oil getting hit by around 2.5 sigma as well. Now, oil was also hit by the news of the SPR reserve release that Biden's planning to do. He was talking about 6 months of a million barrels a day type stuff coming online. Now, market seems to have taken that as having relatively little impact longer term. If we look at kind of the price action, since the start of this week. And then FX, crypto, and other global equities kind of having a quiet week for a change and not really doing too much. As you can see, not too many things in the above 1 standard deviation move last week. Okay, so obviously the main story in rates has been these yield curve inversions, right, which continue happening, and they've just been propagating from different parts of the curve, and now practically every part of it's inverted that anyone kind of cares about. So, that's got a lot of people kind of calling for a countdown to recession, things like that. So, you've got various strategists around the street talking about this, is this a recession signal? What is the track record been? Things like that. Now, you've also got Bank of America strategists pointing out that as well as the 2-10 inversion, you've also got this emerging markets high yield bond prices. They've been rolling over pretty sharply as well. And they're often seen as a bit of an early signal as well for recession. So you've got these 2 kind of key indicators here now rolling over, which is a little bit concerning, right, to say the least. Now, the inversion indicator, as you can see from the chart on the top right, whilst it typically does precede a recession, its timing doesn't have any precision, right? So it's still hard to call exactly when that's going to be. But let's be aware from the chart on the bottom left that this tightening cycle, as is currently being priced in by the market, is looking to be as fast or equivalent to the 94 hiking cycle, right? Which was the fastest hiking cycle that we've had in 3 decades. So that in itself, they're going as aggressive as potentially, or the market thinks they're going to be as aggressive as they've ever been, right? So should that speed up the recession in terms of, maybe we're not waiting 18 months for a recession like we maybe have done in past inversions, right? So that's the thing to be aware of. And then if you look at the bottom right chart, if you look at stock markets, they can generally handle higher rates, but it's the pace of higher rates that worries them, right? So a move like the one we just had, 2 sigma rally in yields over the course of the last month, If you look at what the monthly moving yields typically is, you've had a 2 or 3 sigma move in those short end yields, both on a real basis and a nominal basis. When that happens, usually the S&P on a 1 month forward basis tends to perform quite badly, right? And we're looking at potentially -4 to 5% type returns on the S&P when real yields do what they've done. Yeah, so that's something we need to also be aware of. If we then look at some other sort of leading indicators on the macro side, we had, factory orders printing negatively. They weren't actually quite as bad as expected, but it's still the first negative print since April 2020. We have ISM manufacturing index and new orders versus inventories. So you've got new orders versus inventories is usually a lead indicator to the main ISM index. Okay, so there's a lot of people in the macro space look at that new orders versus inventories to get a read on where that's headed. We can see that's the light blue line that's rolled over dramatically, and we're saying that the dark blue line is going to follow that basically, right? And that's growth basically rolling over in a couple of months' time, if that is an accurate sort of indicator. But you can see that tracks it very, very well, right? It works as a very good lead indicator for the ISM. You've also got another indicator, which, is the sentiment. So we've been saying, Michigan confidence is kind of rock bottom, recessionary levels. But this chart here bottom left looks at the kind of difference between the Michigan sentiment numbers, University of Michigan sentiment, and the conference board. And I've not seen this before, or noticed this before, but basically it's saying that the spread between the two often acts as a bit of a lead. Okay, so what you often get is the Michigan rolling over first and the conference board following, basically. So, in times of when we're heading into a recession, you often see this thing head lower. And if you look at where it is, again, it's like at lows that we haven't seen in decades, basically, right? So pretty concerning from a sentiment perspective. And it's generally inflation that's driving that, right? That's weighing on sentiment. And the fact that your wages, even though they might be increasing, are not keeping up with inflation. And then the last chart on the bottom right is earnings sentiment, right? So we've seen both in Europe and the US downgrades coming through. They've revised down earnings estimates. So the question there is how much is priced in, right? So we've brought down estimates. So you might actually end up seeing beats in Q1 because we brought down estimates and they might actually be in line to better. That's what often happens. But then stocks haven't really sold off to reflect that, right? Given the bounce that we've recently had, right? And then Q2 guidance is probably going to be more important than what Q1 numbers look like, right? Because that's really what we care about. What are we heading into? Not what have we just had, right? So I'd say Q2 guidance matters. How stocks trade relative to the earnings, often give you a bit of a tell, a bit of a read. So are stocks getting punished for bad earnings? Are they actually doing okay and rebounding because expectations have already come down? That's the type of stuff we need to look out for. And earnings are like kicking off kind of next week. Yeah. All right. So that's the macro stuff that I'm seeing at the minute. If we then look at charts and price action, what are we seeing there? So on the S&P, so last week, obviously, we were kind of rallying quite strong to start. We had some noise on ceasefire again and agreement on the peace talks, which was obviously going to be a load of rubbish, as it tends to be. And then the market faded back down again. So we did momentarily sort of push through that Spotgamma call wall resistance area at 4,600. We got as high as 4,635 and then rejected and came back down. Then you had on the actual month end date, you had that acceleration in that massive red candle there into the close. That was basically the JP Morgan quarterly put spread collar roll, where they executed like $10 billion of selling into the market close. Pretty poor execution, if you ask me. But then after that, after that flow was digested and kind of over the course of the following morning and post non-farms, we just mean reverted a lot of that weakness back out again, basically, right? And kind of gravitated back into the vicinity of that 4,600 area. And that's kind of where we've been sitting since, on the S&P. Now, in terms of what we're seeing on the kind of positioning side on options, 4,500, it seems to be the kind of vol trigger to the downside where the street kind of flips back into negative gamma territory and you might see an acceleration. Brent's been basically calling out for a bit of a void between 45 and 4,300. So if we do break 45, we might then start to see an acceleration as put buyers need to come in, because there doesn't seem to be a ton of options lined up there protecting people in the short end. Yeah. And on the volatility side of things in the US, we've seen some put selling, right? So you can see here, S&P sort of put call ratio, kind of had a little spike down again. So seeing some put selling coming back, obviously on the back of markets being a bit more resilient. You like to see that. Means the market sort of, we might be approaching the end of that kind of bear market squeeze when you start to finally see that put selling there. And then over the course of the next few weeks post Easter, if those puts have cheapened up, then you might start to see some bid coming back to vol as people feel like protection isn't crazy expensive. I've mentioned that I think seasonality does matter for these vol markets. I don't think dealers are going to want massive theta bills going into Easter, and the realized vol has been coming off. You can see here in this chart at the bottom left, that's 1 month realized. It's come from the high 20s back towards the low 20s, and that's where 3 month realized is as well. So unless we get a pop back in realized, it's going to be hard for dealers to kind of pay their theta bills now that they're back to long gamma territory. I was looking for an 18 to 20 sort of floor in the vol. You can see the VIX here. It's got a couple of sort of support levels, one that we're right on, and then down at 15. I'd be amazed to see it hit 15, but the way things are kind of going, an excursion below that 18 level is possible if things do go really quiet into Easter, right? And with earnings, you do often get index vol just being suppressed, because what happens is single stock traders often want to own gamma on single stocks for earnings, but they don't want to just pay loads of time decay. So they often lean on the index as a way of getting some theta back, basically, right? So you often see that single stock vol stays elevated into earnings and index vol gets pressure on it, basically, right? So that's often, and then you get that dispersion where some earnings go up, some earnings go down. The index doesn't need to really move that much, but the stocks have their moves, and then their vol reprices lower after the events, basically. That's what you often tend to see. What else? So then now let's move over to commodities. So looking at oil first, obviously oil's been whipping around. But if we look at some charts that I saw in terms of the kind of fundamentals on oil and how tight the market is, right? So Morgan Stanley and Goldman's have put out these charts talking about, so obviously with the SPR reserve release, as Biden's getting desperate, that mean that smelt of massive desperation that hit the oil price by about 7% last week. Since then, it's kind of recovered. I think it's recovered most of it, actually. Potential sanctions coming out tomorrow. That's one reason why it might have recovered so quickly. But fundamentally, the market does look tight, right? So these charts are kind of showing you a massive deficit. So that total line being down there in the red, okay, is showing, a big deficit in terms of the inventories that we need. You've got Goldman's high frequency inventory tracking there, showing, supply demand imbalances. So that they're basically, all of them are pointing to the idea that inventories are just way, way lower than they need to be. The bottom left chart is kind of showing you shale production, and that there hasn't really been a massive uptick in Q1 in terms of shale production. So it's not responding to the higher prices. And the thoughts there being that might be due to kind of greater constraints around labor, materials, supply chains, and things like that. So whereas shale may have come back online before, when prices went above 80 or whatever, we're now above 100 and it still doesn't seem to be coming in any meaningful size. Okay. And then the last chart on the bottom right is just showing kind of how oil and inflation break-evens are kind of tracking each other, and saying that, that latest downtick in oil, we'll see how long it persists, but that downtick in oil is kind of dragged break-evens down with it. And that might lead to some people calling for inflation to have peaked. Personally, I say good luck with that narrative, because I think this is just volatility and noise around what has been a massive impulse move higher in oil, but the fundamentals in oil just look seriously tight. And any kind of headlines we get out of sanctions and stuff could still ratchet oil up by $10 in a heartbeat, I would say. So, yeah, I mean, I'm certainly not in the camp that inflation has peaked just yet. And if we look at food prices and what's going on there, obviously that's a big one, right? So wheat absolutely exploded. It kind of came back pretty hard, consolidating. But, all the agricultural commodities you see here, wheat's the leader, but that's in March. You had cotton, sugar, corn, everything kind of rallying. So food prices on the rise, not good news in general for the world. But what's the big issue? The big issue, as Doomberg's written in his piece about farmers on the brink. If you haven't read it, I recommend you do. There's also a video about it on Real Vision, which is worth watching if you just want to watch it. But basically, the main issue is fertilizer, right? So you've got natural gas prices that are an ingredient of fertilizer. So price of fertilizer has been rising, but then on top of that, with the sanctions, because Russia is such a big exporter of fertilizer, all of that stuff has just been stuck, right? And there's a global shortage of fertilizer, which then feeds through to the crop situation, right? And how much people can plant and stuff like that and what they can afford. So whilst you've got clearly an issue with exporting wheat out of Ukraine and Russia anyway, you've now got another issue that the fertilizer, which is an input into what farmers need to make those crops across the world, you've got an issue with that as well, right? So you've got a double whammy there with what's going on in the fertilizer market. So, I think farmers across the world are struggling to afford it. New fertilizer supply will take time to come online. And the major input is natural gas, which prices are ballooning anyway, okay? Now, the likelihood of price controls and subsidies in the Western nations is rising from what they're saying. That's going to keep prices elevated, but it's going to impact the poorer countries more. And we're already seeing violent protests breaking out in the likes of Sri Lanka and Peru around inflation and food prices and things like that. So, we're already seeing the repercussions, and this is just the beginning, I fear. Now, there was a comment made about fertilizer, but in the US and Europe, farmers have kind of already bought their fertilizers for this year. So really, it's more a crisis for next year, okay? But then you've also got, someone out of the Ukraine, some minister out of Ukraine saying that their harvest is going to be down like 50% or something, basically, right? They've missed a load of planting already in the last month, and it's just going to be a massive shortage of wheat, right? So I think this shit show is ongoing. I think the price impact obviously was a bit parabolic in wheat, particularly. That needed some cooling off. The speculative positioning needed to come down, things like that. But now I think, like I've mentioned before, right? I think we're in this situation where the fundamentals are going to come home to roost over the next 6 months. We're going to see how bad the shortages really are. And markets may just trade up on not a lot of volume because not so much trading is going on, but prices might still need to go higher, right? To reflect the dire situation on the ground. Yeah. So definitely watch that space. But yeah, I would personally, I've been buying little scraps of it. Because I think that's where it's headed. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.